So I'm going to bring you on stage right now, Gospel Obele. So the stage is yours, sir. And please, you can carry on. And I'll be monitoring the chat box. People who have questions, please drop your questions there, so that when he's done with the session, we can get him to answer your questions. So, yes, sir, you can carry on. You can share your screen.
Good afternoon, everyone.
That. I'm going to even try. I'm going to.
All right. So.
Okay. Yes. Carry on.
All right. Good afternoon, everyone. Thank you again for your time. Today promises to be a very intense and interesting session here, because we'll be running through on the key dynamics we need to know, as a strategic guidance to engage in markets in 2021. And this cuts across for players in the financial markets, it cuts across for players in the consumer markets, and for businesses and even policy experts. All right. So whichever rung of the ladder you are in terms of career practice, access to market and market engagement is very critical for 2021. So we need to understand what are the changing dynamics and what is currently influencing the markets, and how can we engage profitably, all right, to be preferably on the proactive end of the value chain. All right, so we're looking at Nigeria in 2021. We want to navigate markets profitably. How do we navigate markets profitably? And this is the Outlook Snapshot. The Outlook Snapshot being that every year, Streetnomics, which is an organization I manage and lead, always rolls out an outlook for the year. All right, although we do that on a very private level because of the kind of strategic information we share. So this session we are having is what we call the Outlook Snapshot, meaning this is a comprehensive summary of our outlook for 2021, and coming into 2021, we'll be having a more robust session with corporates and different stakeholders in the value chain and all that. So yes, let's start. Please, can we move on the slide?
Okay. So let's try to go to the second slide. Right.
Okay, so we'll look at just a run through of an introduction, and then we'll look at 2020 before COVID-19, and then on post-COVID, what happened. We'll look at the state of the economy. We'll look at the outlook for the Nigerian economy in 2021, more or less a picture of what it's going to look like, and then a breakdown of how we can engage markets profitably. Next slide, please. Next slide, please. Okay, so Streetnomics is actually a socioeconomic research and a market intelligence and development firm, and also we're into brand building and evaluation. We primarily help businesses, policy actors, social enterprise actors, and even government, all right, make critical decisions using data. And part of that data output is using information to enable and intelligently foretell possible success factors or outlines for our engagements as businesses or whatsoever we're doing along the value chain. So this is just a summary of what we do. Please, can we move on to the next slide? So this is just a summary of a few clients we've worked with at different levels of core market research, business advisory, outlook engagement, and intense economic research and market strategy session. Please, let's move forward. Thank you. We've also had the opportunity of being on the media 56 times in 2 years, speaking strictly to economic issues around market development, issues around business development, and issues around government policy and international engagement as it pertains to the Nigerian economy and development in the large scale. Please, let's move forward. Okay, let's move forward. So let's look at 2020 on pre-COVID. And we want to do this carefully because we want to be able to help us understand where we are right now so that we can appreciate where the market is going and take advantage of market opportunities that will be coming our way in the next fiscal or financial year. All right, we saw that as at January 2020, growth had declined to 1.87%. All right, the central bank had raised the lending deposit ratio to 60%. Of course, at the time, the Nigerian borders were closed. There were FX restrictions and bans on products and services. We also saw a situation where the finance bill hiked from 5% to 7.5%. All right, Nigeria finally chose to sign the AFCTA agreement. And for the first time in a very long time in Nigerian history, the budget took effect from January 2020. Okay, we also saw a growing interest by the central bank in cluster real sector markets like the creative sector, and of course, a growing poverty narrative and the likes. Let's move forward. What all of these narrative meant for us was that over the years, coming into 2020, there was an increasing growth, how would I put it now, increasing cost spread on the economy. So in as much as the economy was making one or two significant advances, all right, there were increasing cost spread on the economy, and added to that was a strong decline in the pace of economic activities. All right, so what we found out was that in 2016-2017 recession, coming out of that recession, we could not, although because we don't have the structural buffers, all right, to hold the recovery together and to scale recovery back to the days of 3 to 4 to 5%, and also make this growth inclusive. All right, we had a situation where we were juggling between a 1 to 3% recovery growth, and being the fact that the events that affected or shaped the 2016 and 17 recession were largely on the oil price, and of course the US discovery and scale of the shale oil. All right, and they being the largest importer of our crude oil and all of that, there were a lot of changes and dynamics in the oil markets, which largely affected foreign exchange earnings. All right, and it largely affected our ability to import properly. So, and because it's also an economy that's largely dependent on semi-finished or finished goods as imports, all right, it affected economic activity. So that change in the global narrative and global market spread of oil, all right, affected our ability to bounce back on a higher level of growth rate consistently, like we were in about 3 years before 2016. That's 14, 15, and early 16. So this narrative affected the Nigerian economy so fundamentally that we could not come back at the level we used to be, talk less of to plan strategically for development. So in the midst of all of these growing dynamics, I remember being on ChannelsTV in December 2019, and I was mentioning that it's very possible that there is a looming recession ahead, being the fact that growth rates were dwindling between 1 and 2%, and markets were fundamentally on a slowdown, in as much as a lot of activities were going on. All right. So what we saw that changed the game and brought the recession and all the likes closer than ever before was the pandemic. All right. The pandemic literally fast-tracked the pace at which economies rose or got into recession. And being the fact that Nigeria is a developing economy and we're on the lower rung of the ladder, it simply meant that the impact of whatever happens on the global sphere hit deeper on the structural dynamics of the Nigerian economy. And when anything hits on the Nigerian economy, being as a result of the poor economic structure and ability to bounce back and be resilient, it affects the cost, how will I put it down, the cost of living of society. So like I would say, a slight drop in oil prices or a change or a global shock of some sorts directly hit on the pockets of a Nigerian consumer. All right, no matter whatever industry you find yourself in or have invested in or you do business in, you realize that it all still boils down to the functionalities in the marketplace. All right, the marketplace determines what to produce, how to produce, and for who to produce in the long term. So these are the critical reasons why we need to understand what the market holds for us in the coming year. Please let's move forward in the presentation. So in 2020, we realized that as at March on post-COVID, the following happened. Can we move forward? Yeah. the economy had, is this the next slide, please? All right, so the economy had already hit on the recession so early because of the COVID-19 pandemic, all right? There were lockdown and also what we call lockdown-induced trade-offs. The trade-offs were between public health and economy, all right? Actually, I don't think this slide is on point. Please just give me 2 seconds to pick up my laptop. Sorry, I'm good. All right, so I had to get my other laptop so I can follow the presentation properly from my end. All right, so I'll kindly encourage that as much as we do this with this presentation here, we also listen closely because I want to be able to move at a faster pace and to be sure that I'm not missing my points based on the slides and all that. All right, so like I mentioned earlier on, there was a trade-off, and the core implication for this global lockdown was that economic activities had slowed down. And when economic activities slowed down, we saw a situation where even on the essentials, on the basic necessities of life, all right, supply could not meet demand because supply chains, logistics chains, and the likes were affected at a very, very base level. All right, so what happened was demand was on the rise. And then what this naturally does to the average man is that he begins to experience an increasing cost, all right, in the need for essential services, in the basic purchase for essential services. And then businesses generally also saw a gross decline in revenue, in volume of transactions, in volume of sales, and the likes. So what COVID-19 basically brought to us was a direct, clear market redistribution, all right? Some industries suffered for it. Some industries benefited as a result of it. And we saw that globally, the global economy went into what we call a recession. And in the act of thinking of how to navigate and escape all of these things, all right, businesses started to introduce newer things into their models, all right. We even saw PMI drop sharply as at March 2020. And what all of this is just primarily showed to us was that the business environment had changed drastically, okay? We saw a drop in volume of transactions, the weaker purchasing power, and tougher consumer choices, all right? Weaker purchasing power, not necessarily because incomes were dropping, but because the cost of living had risen, all right? And because cost of living had risen, it meant that there will be fewer money chasing few goods, all right? And then that would lead to a situation where people cannot afford the normal quantity of goods and services they would naturally afford initially. So these are the little dynamics we found here and here. And then brands started introducing newer ways of doing business, okay? Eco Hotel started doing home delivery and the likes. And of course, social distancing also came with its own operational costs, all right? And all of these things were transferred to the final consumer through normal transportation, food purchase, and the likes, all right? There were also positions or situations where individuals lost their jobs, all right, as a result of all of these changing market dynamics. A few sectors suffered this loss. We saw that travel, tourism, and aviation, hospitality, recreation, and all of that were deeply affected, all right? And a few other sectors we saw had found a way to thrive through the pandemic. And that was simply because these sectors happened, number one, in spite of government. Number two, these are sectors where they are very high on numbers and what we like to call the inelastic consumables, right? That means that no matter how bad things go, people will definitely eat, which speaks to agriculture. No matter how bad things go, people will withdraw money, they will make payments, which speaks to fintech and financial services. No matter how bad things go, people will need drugs. They will need medical care and attention, which speaks to health. No matter how bad things go, people will need some form of digital engagement, social media, and all of that, which spoke to technology. And then in this regard also, a lot of businesses started losing value started losing market share, and thus the need to begin to ask the deeper questions around what is the next big thing, why the uncertainties are happening and all of that. So consultancy services also increased, though at a relative level, all right? And then logistics picked up because there was an increase in the logistics industry. So prior to that time, the state government had banned Okada, all right? So what we found out was a lot of people were now moving from Okada business to delivery businesses. And to close the supply-demand gap, delivery services were on the rise, all right, to enable goods and services move from market to final consumers, all right? So now on post-COVID, a few considerations we need to bear in mind before we move into the crumbs of the matter. Next slide, please. Is that number one, all right, COVID-19 only revealed managerial excesses across sectors, all right? COVID-19 did not disrupt in the real sense. It only revealed managerial excesses around sectors. It only led to the rise of remote work. And of course, being that Nigeria has not really built a strong human capital development policy or a strong labor market policy, we saw that a lot of companies were not ready for the remote work experience. As such, there was an increase in the nature of a learning curve. That means it became more complex, and a lot of organizations did not have any other option than to unlearn and relearn the learning curves around remote work. All right, growth on the reactive as a function of sectorial impact. All right, and then there were growing slow recovery for businesses and corporates largely. All right, there was also increasing need to manage risk. All right, there was widespread uncertainty due to poor economic management, and then a lot of customers sought to reduce discretionary spending, but then increase cash flow. All right, so if you're in the business where you do premium and all of that, you realize that it has become relatively difficult to sell at a premium because the average consumer now think of options. All right, they now think in options, and they want to still get value for those options. So what that meant that it redistributed what we call the markets and how values are being exchanged in the market. All right, so for example, now for insurance companies, we realize that a lot of people wanted to find a way to manage the risk just in case something happens again, another wave of COVID-19 hits. All right, but in doing that, they did not want to spend excessively on a premium package or something like that. All right, so what we realized was there was a growing how the market was distributing, consumer appetites were changing, they were seeking more options. As such, brands, corporates, even companies that are listed on the Nigerian Stock Exchange started thinking deeply on how best to engage the new market distribution, how the market was being redistributed or is being distributed. All right, let's go to the next slide. Then coming down towards August, September was a major narrative that changed the game. And it was the NSAS narrative, all right? And what happened was this made the markets further redistribute because it was a narrative that were built on what I would call a widespread system brutality and then poor governance, all right? So, and all of us we all know how this whole process went down and how the government also responded to this NSAS. Now, you may think that these things are not necessary, but these are the major and critical things that shape how markets function, how players in different markets interact, all right? How the demand and supply side of markets redistribute itself, all right? Because they are also called market forces and the likes, okay? So until we understand the market forces, the players, the triggers, all right, the influencers, and how all of these things will shape together, all right, to automatically probably inform market capitalization, the ASI, and even how consumers consume brands, we may not be able to invest profitably and be on the proactive end of these markets. Now, there are what we call rising implications for businesses and the business environment largely. We saw that there was an increasing loss of confidence in the political economy as a result of how the NSAS protests were handled. There was an increasing fear of the unknown. There was a growing insecurity, all right? There was another wave of brain circulation, and which we want to call talent redistribution. So coming into 2021, the conversation around talent management is going to be way more complex than it was before. Motivation will no longer lie on the hands of good salary pay and the likes is most likely, all right, going to lie on the softer issues as a result of all the events that has unfolded this year. So there were growing uncertainty and then lack of clarity and policy direction. All right, this lack of clarity and policy direction have made investors and a lot of financiers and even market players be on the defensive side of the market. All right, nobody wants to invest yet until they are clear about the policy direction or how big brands or corporates where we have shares and stocks in would respond to market changes, especially in the uncertainty that comes along with 2021. All right, now let's look at the economy quickly in review, and then let's drill down insight into statistics. Okay, if you take a look at the economy, all right, we'll see that globally, all right, the IMF had please let's move to the next slide. The IMF had projected a 3.3% negative growth in 2020, all right, although there are hopes that as at 2021, all right, the sub-Saharan and developing economies, please come to the next slide, sir, would reach a 6.0% growth. Now, this is still a bit very tricky and dicey. Can we move to the next slide? This is a bit tricky and dicey because for emerging and developing markets, no, please go back. Please go back to the previous slide, please. The next one now, please. No, forward, the next one. Yes, yes. Thank you very much, sir. Thank you. So this chart, the previous one. Okay, so we try to show the 8-year quarterly GDP trend. Exactly. Thank you very much. Thank you very much. We try to show the 8-year quarterly GDP trend and how all of these dynamics are affecting economic activities. As we can see from Q4 2015 to Q3 2016, there's been a sharp consistent decline. Now, as at from Q3 16 to Q4 17, there's been a relatively increase in share of GDP and all of that and economic activities. But if you watch from 2017 to 2020, GDP has relatively, stable and dwindled around 2%, 1% into the 3% axis, and a little bit downwards in first quarter of 2020 as 1%. Now, when we move forward into what we have currently, we've seen that as a result of the pandemic, there's been a sharp fall, from Q4 2019 to Q1 2020, down to Q2 2020, and again to Q3 2020. Now, the conversation now is that will there be, the monetary policies have made promises that by Q1 2021, we should be out of recession. In as much as that's pretty much an optimistic case, all right? In terms of markets now, the markets will not respond accordingly because players, investors, and all of these things, all of these different stakeholders are still on the lookout as to what the policy direction is in getting out of recession. Because what we currently have now are stimulus packages and different funding programs just to enable the real sector come out of this experience, right? But the markets understand that because there are structural deficiencies and things will not remain or will not go back to how we used to be in 2014, 2013, 2015, it simply means that the likelihood of getting into recession subsequently is higher than it ever used to be. Why? This is simply because the dynamics around recession in the Nigerian economy is largely hinged on the global oil price. All right? And that's because every area of every part of the economic functionality, which is still hinged on foreign exchange, is dependent on the global oil price. Now, until the non-oil aspect of the economy is properly unlocked, and let me just quickly say this, the Nigerian economy is technically diversified, all right? It's technically diversified. The only challenge we have is that we've not properly enabled one, and diversify the non-oil sector revenue base. So I'll say it again. The Nigerian economy is technically diversified. The only problem is that we've not properly enabled, first of all, all right, through infrastructure, human capital, education, access to market, access to finance, and all of these things, all right? We've not properly enabled and properly unlocked the revenue stream of the non-oil sector, especially as it pertains to exports, all right? So the oil economy, the oil sector currently contributes less than 10% to the Nigerian economy, but over 70 to 80% of foreign exchange. So when you look at it vis-a-vis economic structure and revenue base, you see that it's it's a trade-off sort of, all right? And that's what is that same exact thing is what's happening in the non-oil sector. So the non-oil sector contributes about 90 to 92% thereabouts, all right, in terms of GDP share, but it contributes less than 30% of foreign exchange earnings. All right. So until we unlock the revenue streams properly, and you cannot unlock revenue streams when you've not been enabled or when you're not ready to access markets, especially international markets. All right. So these are the major intricate issues that are shaping that market dynamic. So regardless of what the central bank says or what the presidency says around getting out of recession in 2021, in Q1 2021, you realize that the market is still a bit on a lag level. It's still on a bit on lag level because the major functionalities that drive the markets are on the non-oil end. And there's still a lot of coordination, a lot of putting together, a lot of housekeeping that needs to go into that sector, okay? Consumers are still on the defensive. Brands are still reactive to respond. Now, let me quickly also say this here. Anytime you see the GDP numbers reported, it is important to note that the nature of GDP reporting in this part of the world, mostly globally anyways, is such that it sets us to react to the market, all right, to create reactive strategies to the market, not proactive strategies to the market. A lot of corporates, a lot of businesses, even on the Nigerian Stock Exchange, react to the market. They do not act proactively to the market. And that's because the GDP report does not give you a real-time picture of what is currently going on in the market. All right, it's a lag-informed picture. Now, let me just say it like this. GDP for Q1 is reported in Q2. It means that when GDP for Q1 is reported in Q2, other events are already happening that shapes the market that are not currently being captured. Sorry, they are not currently being reported till the next quarter. All right, so captured GDP is different from reported GDP. And what corporates need to understand, investors need to understand going into 2021 is that they need to be able to clearly interpret the current ongoings in the economy, all right, so that they're on the proactive end to engage the markets. So engaging markets profitably has left the level of making assumptions or waiting to see the GDP report, the inflation numbers. No, you are setting yourself and the organization where you lead or function in to be on the reactive side. And because consumer market dynamics are now changing, it's going to be a lot more difficult and uncertain to engage in 2021. So my first level recommendation is this: find a way to engage the market proactively, all right, by following real-time indicators. And part of these real-time indicators are PMI, unemployment, and inflation. Once you understand those real-time indicators, at least to a point, inflation is always also a 1 month lag, but it's a safer lag compared to a GDP lag, which is a quarterly lag. All right, it gives you the position, it puts you in a position where you can easily predict, all right, and easily inform your strategy for the next quarter and the fiscal year. So we saw where inflation numbers also, all right, moved in the same order because of the border closure, the VAT increased, and all of these things. And it's very simple. Once there's an increase in the cost of production, all right, the producer pushes that cost burden to the final consumer. But because, like I will go back again and say, we do not have the right economic buffers, we realize that the cost is passed on to the final consumer across the essentials, which are food, education, housing, transportation, and all of these things. Okay? These are the pressure points for the average Nigerian consumer. So if you're in FMCGs, or if you're an executive, or you work in markets, or you work in the stock exchange or somewhere, you need to understand that around the core of FMCGs are tougher consumer spending choices, which affect profitability rankings of companies. So it's going to be a lot easier to forecast what the profitability position, the cash flow position, the earnings position of many companies on the Nigerian Stock Exchange before the financial year runs out, just by looking at how they are responding to market redistribution and market dynamics. Because at the end of the day, it boils down to the consuming power or the purchasing power of the average consumer, who is directly being hit by higher costs pushed by government policies on him, not necessarily because he's making more income or whatsoever. All right, going forward, let's move straight to sectors. All right, we realize that a few sectors are on the leading end. Okay, and these are key sectors we believe that consumers need to watch, or market players need to watch. The next slide, sir. Telecommunications, health. All right, a few of these sectors were affected as a result of COVID-19, but what we've realized that majority of these sectors are on the resilient part, on the resilient end, number one, or they border on the inelastic consumables. So for instance, now telecommunication has grown to become a resilient sector because by the play of numbers, by the growth in digital engagement, mobile penetration and all of that, all right, the rise and engagement in telecommunication, the engagement in telecommunication market will always be on the rise, relatively over a period of time. All right, health is borders on inelastic consumables. People will always take medicines and the likes, go for checkups and the likes. All right, and a few other sectors, agriculture and the likes, as we go ahead. All right, so in the new year, it will make a lot of sense. Let's move forward, please. It will make a lot of sense to push investments into the core of where consumers are seeking to spend the most. All right, which is along the lines of FMCGs or along the lines of core resilient sectors. Okay, let's move quickly to, I have a slide on the budget, but I don't have time to go into all that. I want to talk on how business will respond because of time. Mind you, these are also Outlook presentations that we are going to amplify in January, and then we're going to do like an Outlook tour. We're taking them to different organizations to present them and then make a business case for alignment. We're also seeking to engage an Outlook workshop session sometime in the first Saturday of February at 4 points. So if you're interested, you can find a way to reach out to me and we'll take it further from there. Let's move forward to the monetary policy end. On the fiscal policy side, you realize that the federal government has, yes, moved from proposed 2021 budget to the appropriation bill, right? Appropriation Act, rather. So it's now assumed that the budget will take effect from January, but technically from March, all right, given a 3-month window to conclude 2020 public expenditure and all of that. All right, so there's going to be it's going to be a spendthrift economy in 2021. A lot of spending will be going on, being the fact that Nigeria has gone into recession, okay, and the conventional knowledge would be to spend our way out of recession. It means that markets would experience more, I don't use the word volatilities, all right, but there will be so much money in circulation. All right, there will be so much money in circulation, but the government policy, the political direction and all that of the policy direction of the political economy will inform how these resources are distributed in the markets, okay, and across which sectors. So we want to also look at where are key sectorial areas for the fiscal sector stakeholders, or okay, where would they want to spend on, and what kind of projects to be spent on. And for example, if you run an insurance firm or you're an executive director in an insurance firm, would you want to seek to insure government projects or JV projects and all the likes, where critical capital expenditures will be going into? So there's going to be a lot of liquidity in 2021. However, it's not going to be just information that meets the eye. It's going to require a lot of strategic understanding, strategic movement, because the policy direction is still not so clear, and then recession is still on the way. There is a second wave of COVID-19, and all of this uncertainty can go a long way to blow the vision or direction of the private sector investor and the like. So it's important that we engage markets from a proactive point of view by seeking to understand first before we invest or before we engage at whatever level. Let's move to monetary policy. We saw that purchasing managers index had dwindled over time, all right, under monetary policy now. Okay, and this also spoke to the fact that consistently over time they've been a form of decline, all right, in the level of economic activities, especially across supply chain, all right, and we are seeing that these numbers are finding ways to, how will I put it now, to break out of the threshold of 50%, meaning that some other sectors are seeking to break out again. Not necessarily because of any active, solid government policy, but because these sectors borders on inelastic consumables, all right? That means things people cannot do without. People must eat, people must transport, they must wear clothes and find a shelter. Or because these sectors are naturally resilient, and they are resilient because they thrive a lot on the numbers. But when you now look at sectors that have one or two conditionalities, you realize that they are more on the receiving end on the purchasing manager index declines. All right, let's move forward into monetary policy reforms and outlook. So the CBN is largely thinking, just like the fiscal policy also, like the government, the FGN, they're largely seeking to do a lot of, how will I put it, extension of moratoriums, all right? Yes, the drive so far has been more expansionary, relatively, all right, than contractionary to a large extent, all right? Although policies from the fiscal side, all right, and in my own simple opinion, other areas where the central bank is seeking to play in have clashed and made it look like their expansionary drive has been inconsistent. But I think the target for the average investor over the years, over time, into 2021 is to, like I said, mentioned earlier on, focus on what is most important for you. All right, we are still, our policy development as a nation is still improving. It's still largely at its infant stage, because these policies, if you look at it from a wider perspective, are not so much complementary in the sense. All right, so you want to be careful about where you put money and why you put money. All right, and what sectors the central bank will be careful to regulate. All right, and what sectors the central bank will be quick to regulate, because we'll be seeing a lot of that in the next year. So many more circulars will be released on some key sectors, and in terms of tighter regulations than some other sectors. So it now borders on investors to sit back and think clearly. For example, the real sector and creative sector will see a lot of expansionary drive. All right, and as you have seen, the federal government has reopened most of its borders, all right, which simply means that there's an expansionary drive to reopen the economy. Okay, and these are critical areas where we can latch on. Okay, okay, let's move. So the CBN, the monetary policy outlook for the financial system now, 2 slides away, please. We realize that the central bank wants to focus largely on capital adequacy. All right, the central bank wants to focus on developing internal controls for risk management, and also building business model resilience, all right, and adaptability among financial institutions and non-financial institutions to a large extent. What this simply means is that, like I've been mentioning earlier on since the presentation now, that a lot will border on a lot will happen in 2021 that will redistribute markets, such that even monetary policy committees and the circulars and all that the CBN is doing right now is now heavily bordered on ensuring that the banks stay liquid and they have enough capital to navigate if a second wave hits at a very, 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 very intense level like the first wave. All right. The central bank is now seeking to introduce more internal controls, all right, and risk management. So a part of its engagement is regulations, which will later play on markets, is that you'll find policies trying to play on the adverse, all right, on the contractionary, and some other policies trying to play on the expansionary end of things. So it means that for the average investor, there is an increasing need to pay attention, all right, because these are the 3 core. And the goal for the CBN is to first protect the banks, all right, or protect other institutions, and even the NSC, all right, any other monetary institution or financial market institution that are synchronized at the level of regulation, a lot to bother around the core of these three things, all right, and ensuring that banks, companies, brands, all right, over the time or throughout the months or fiscal year in 2021 are coming off resilient, all right, and willing to adapt to changes. Okay, so it means that the market will keep redistributing, consumers will keep re-engaging. So it's not going to be a one-size-fits-all. All right, a company stocks that was high and performing well today, tomorrow you just see a hold recommendation because investors are taking a cue back to probably rethink how they want to engage, or even the brand themselves or these companies themselves are thinking of how best to re-engage the market. So there's going to be a lot around ensuring there's a lot of capital in the banks, all right, finance in the banks, a lot of internal controls and risk, and then resilience in the sector. Okay, so if the apex body is thinking of this, then as investors and people who do business in different sectors, all right, needs to begin to think of these things to ensure that we are on the proactive end. All right, the monetary policy outlook for 2021 is to exit recession in Q1, which I think is quite slim, being the fact that there are increasing fear and uncertainty and the rise of a second wave. Commodity markets are currently being affected. Financial markets are also being affected, and these markets are looking for ways to navigate the current realities. Okay, now the monetary policy outlook is also to intensify diversification efforts and grow revenue base, especially in the non-oil sector. All right, and there is a growing emphasis on agriculture, ICT, financial inclusion, and infrastructure finance. So you'll be hearing more of newer bond initiatives, okay, newer security initiatives that will be introduced along these lines, because the goal is now, if you can secure our development process, especially on the core food security, all right, on technology adoption, fintech, and then increasing the chances of the underbanked or underserved, all right, that means we can increase the resilience of markets. Are we together? So market resilience doesn't just bother on buying and selling or how well companies are now doing. It now borders on ensuring that there are a lot of financial initiatives to protect the consumer and to position the consumers properly, all right, to, how will I put it, to reinform the dynamics around demand and supply. So what we call as markets will be redistributed based on many other factors that will be, how will I put it, reshaping itself and playing out in 2021. All right. So the Nigerian economy in 2021. The next slide. From our own analysis and every other thing we're trying to do on the background ahead of January, we've realized that it's going to be a slow. The next slide, please. It's going to be a slow but heavily cautioned recovery. All right. This recovery won't come as easy as the central bank or the financial institutions are seeking or thinking about it. It's going to come in such a way that, in as much as it will require a lot of spending and expansionary policy, it's also going to be such that the recovery would sit on the fence or on the borderline. And that simply means that at the verge of any crack in the oil sector, all right, the economy would easily fall back to another recession. If there is going to be another second wave of COVID-19, the economy will fall back at a recession. So what we are saying now is that over time, in the last 5 years, the Nigerian economy has seen recession for 2 times. We've entered recession for 2 times in the last 5 years. This simply means that if care is not taken, and if we are not seeking to recover on a resilient and a more intelligent and structurally based level, especially as it pertains to non-oil sector development and growth, as it shapes markets and all of these things, all right, we will be back to recession in a shorter time than it took us to get where we are now, all right? So going forward, how do businesses navigate these headwinds, and how do we map opportunities for growth? Number one, we need to realize, next slide, please. I need to round off now. We need to realize that it's going to be, number one, a slow growth economy, all right? There will be expanding pockets of cost pressure. And these expanding cost pressure is as a result of broken value chains and supply not meeting demand, not because there are no supply of those items or because we cannot make them available. So, for example, now there are, in quote and unquote, intelligent assumptions around food security in how would I put it now? Shortage of food in 2021. All right, there are intelligent assumptions around that, and that's because not necessarily because we cannot produce more, but we cannot produce at the quantity and scaling the quality of that quantity, from farm to market. All right, so as a result of that, it means that consumers will keep having to pay more for less. All right. And then late into 2020, we saw the rise in power tariffs, fuel tariffs. And what all these things will simply do is that to increase the cost of mobility, the cost of transportation, the cost of doing business primarily. And then with the recent finance bill seeking to increase VAT at 7.5% to 10%, it also simply means that the average cost per item of a product will be pushed to the final consumer. So there'll be an expanding pressure, there will be expanding pockets of cost pressure. There will be more price sensitivity for consumers, but then consumers will be seeking more options. All right, so a lot will be will be playing out in the markets, in different markets in 2021. Insurance and brokerage firms will pick up more creatively because people want to find creative ways to protect their options. All right, let's move forward, please. A few things to bear in mind doing business in 2021 is to ensure that, number one, next slide, please. You're rounding up now. The consumer dynamics are changing, all right? The consumer landscape are changing, and we need to have this in mind. The next slide, please. We need to understand that the core pressure points are across education and transport, all right? There will be increased spending in 2021, not as a result of increased incomes, but as a result of increased costs on inelastic consumables like salt, sugar, onions, cost of transportation, things people cannot do without, all right? People will now become more price and brand sensitive. There'll be increasing financial insecurity, and people will need more options to choose from, all right? Let's move to the next slide. And the state of the consumer is going to be the new normal because we do not have the adequate structural reforms to protect and scale recovery sustainably, even since 2016. All right, moving forward now. Next slide, please. Businesses, and I'm ending here. Businesses, investors, directors, and stakeholders generally have to think through what we call, what the Harvard Business School calls a discovery-driven planning. It simply means that how do we engage markets? How do we reintroduce products and services? How do we interact with consumers? How do we decide on where and why to invest over time as markets redistribute in 2021, and we are doing that safely by playing on the proactive end. Those are the big questions that all stakeholders have to ask themselves to maximize markets profitably in 2021. And these things border a lot on reinventing the business model. Okay, it can also be reinventing your investment model. All right, where do you choose to invest and why? So currently, a lot of people are playing in the intuitive box, but the new market dynamics is asking and pushing us to move from intuitive to counterintuitive. All right, so what do we need to preserve? What do we need to eliminate? And where do we need to innovate? And across these three lines, we need to start asking ourselves, what processes, units, resources, partnerships do we need to engage, all right, to ensure that we are on the proactive end of the market, we are reaching consumers properly, and we are even investing in organizations that we know. So, but as an investor, by understanding how this model works, you can, through this model, evaluate the different companies on the stock exchange or on the financial markets to understand which organizations are truly moving on the proactive end of market engagement. Very important. Otherwise, you will have your investment run down the drain because these companies are moving towards the reactive end of the market. So you need to have this model at the fore of your mind to redesign and rethink engagement in 2021. Let's move forward to the next slide now. As corporate and as different stakeholders, we must understand that the scale of market engagement and distribution is largely dependent on the consumption per capita of the average Nigerian. All right. In as much as Lagos has is the largest city in Nigeria and is developing a huge consumer class, we realize that other cities have a bigger consumption per capita. And that's because they have wider disposable income brackets, all right? And the cost pressure in those other state economies are lesser compared to Lagos and Abuja. So I see a lot of brands. Let's move to the next slide, please. I see a lot of brands I speak to a lot of brands every day and businesses who request for business plans, feasibility study, some form of market guidance and the rest, and even some form of economic reporting, and the narrative is centered on Abuja or Lagos or Port Harcourt. But I want to use the opportunity to encourage us to begin to open our minds to think of other markets in Nigeria where we can do business or seek to invest in, all right? Or look for an SME who is thriving in that area and invest in that SME because of the law of disposable incomes and how those disposable incomes are spread across at least the top 20% in those state economies. So when you take the top 20% in those state economies, taking them across clusters in different regions, you realize that you're engaging the market more profitably, all right? You're spreading your portfolio more intelligently, and then you've reduced your risk levels, okay? Because of the different dynamics that's currently ongoing in the Nigerian economy, the Lagos economy and the Abuja economy is going to be heavily driven on cost in 2021. So it's driven on cost and uncertainty. So for the average consumer, for the average investor, you want to think of markets from an angle of how do I engage Lagos and Abuja more proactively while spreading my risk to other cluster centers that have stronger disposable incomes and have higher chance. So yes, the cost of doing business and every other thing spreads across every part of the Nigerian economy. But what I'm trying to say with this slide is that the heat and how it informs market redistribution, okay, or market engagement in 2021 is lesser in some areas than some areas. All right, so in as much as you want to put your investment and protect them in area 1, you want to spread your risk in area C, B, and D that are clustered in a particular region. So if you look at the 3 major clusters here, Ibadan, Ogbomoso, Ilorin, and even Abeokuta are strong cluster, high disposable income areas where you can think of creative investments to engage. You can even start a business or tap into an opportunity there or do something in those areas that can scale your chances, okay, of reducing your risk in other cost-intense centers like Lagos and Abuja, or disposable shrinking centers like Lagos, disposable income shrinking centers like Lagos and Abuja, or shrinking middle income class. So I see a lot of businesses who come out and they want to sell to a particular market and they're keen on Lagos and Abuja, the middle class. It will surprise you to know that the middle class in Nigeria is currently shrinking, is becoming poorer on a month-on-month basis. And the same middle class are thinking of options and they are no longer and they are seeking to reduce discretionary spending. All right, so you want to play on numbers and spread your investments on clusters where those numbers can scale quickly. That's the advice. All right, so you can also think of the north angle. Yeah, there are insecurity challenges and all that, but when creatively explored, you want to add the middle belt to it, the north central belt to it, and they also want to think of the southeast/south-south, Benin City, Enugu, Onitsha, Port Harcourt, Warri, and all the likes. There are higher disposable clusters in those areas than trying to centralize all investment and engagement in Lagos and Abuja. Please, let's move forward. So data, engaging data and understanding how best to engage data is very critical. Next slide, please. It's very critical, all right, to scale market engagements. I will read this quote and I will say a few things and end the session. Data is not like water. It's abundant yet desperately needed. Brands are incorporating data analytics into nearly every decision they make, all right? In many cases, it's displacing design and creativity as a heart of brand strategy. Visual media content assets and channels have now emerged. New visual media content and channels have now emerged, from mobile apps to VR to infographics to rich media ads, etc. And these things require what? Tremendous creative vision and resources. Design will become the new big data. which is the next differentiator as big data becomes the new normal. Now, take the word big data out, the word big out. Data is now very critical. It means that it's not going to be a one-stone throw. So I'll currently engage and encourage us to seek to play on the proactive end of the market. Keep in touch with government policies, keep in touch with CBN expansionary policies, keep in touch to understand how policy inconsistencies may conflict the expansionary drive on the of CBN particularly, and how you can, all right, in all of these things, okay, hedge your spending or spread the portfolio of your investments, or how your brand seeks to engage the market. And as you're doing all these things, you need to understand that at the end of the day, it all boils down to the consumer. It all boils down to the consumer. If a particular bank on the Nigerian Stock Exchange loses 50% of the consumers, it will lose its profitability, its earnings, and everything for that financial year. So what keeps these brands running and their numbers, running on the stock exchange platform and other platforms globally are because they have a whooping market who are seeking to buy at a particular price. Now, the price, these consumers are becoming price sensitive. At the same time, they are seeking more options. At the same time, they are seeking to secure, all right, their options and all of these things. So being able to navigate all these intricacies in 2021 is what secures the profitability of market. And I'll strongly encourage for us who have organizations or who are directors or who work in different organizations, seek to have quarterly outlook strategy sessions like this, all right, to help you keep a gauge on how the market is currently redistributing itself. Because these things will go a long way to reinform and reinform. 2021 is going to be very uncertain, but the winners of that financial or fiscal year are those who engage in what we call discovery-driven planning. And the heart of discovery-driven planning is seeking on what to stop doing, what to keep doing, what to stop doing, and what to start doing through the lens of data and intelligence. Thank you so much. Next slide, for having me, and I'm open to questions.
Wow. What a very enlightening session. Thank you for that power-packed, lots of insight in the short time we're able to give you. So if you have questions now, you can ask your questions. Two people have asked the same thing. They're asking that will there be a possibility of them getting the slides? Then another person is, will they get the slide? Two people have asked that we share them the slide. What's your answer to that?
So number one, I may not be able to share the slide now because these are, I call them snapshots. We are developing the ideas for our official Outlook launch on February 6th, 2021. So we can't give out the slides yet, quite honestly. But maybe, I don't know, maybe I and Michael will discuss privately to find a way to share maybe a one-pager summary brief of the session or something, I don't know. But we may not be able to share the slides yet because these are ideas that are still being developed and fleshed out ahead of January 2021, particularly February 6, 2021. So we are having our Outlook workshop, meaning all of these ideas will be broken down into core strategy dynamics for businesses and investors and all that. And we are having that session at 4 points by Sheraton in February. And so these are deep ideologies. So we're not even done with this. It's still in progress. So that's why we call it the Outlook Snapshot. All right. Front level ideas are coming to our minds, and we thought we embrace the opportunity to share them here. So I'm so sorry we can't share them at this level, but we can find another alternative. I'll discuss with Michael to pull this off.
There's a video recording of this session, so you can always rewatch. If it's just a slide you're interested in, you can be fast forwarding since you've partaken in the live session. You could be like, okay, fast forward. It will be like a reminder, because I guess what people want slide for is simply also to be able to fast forward on and have a fallback on what you said. So you can use the videos for now as as your way of recapturing what we've covered. So someone is asking, Opeyemi, because Can you unmute yourself and ask? Sometimes I prefer it when people ask their questions directly, except if you want me to read it. Opeyemi, you've asked a question. Do you want to ask him directly?
No, you can read it, Mr. Michael. Thank you.
Okay. So he's asking that what business can one possibly run with Lagos state government? What, in your opinion, is the direction the state is going?
Okay, so quite frankly, there are no clear policy directions that have been stated ahead in 2021, but the way the state runs its economic policy is such that it's already articulated in it. There is a plan that runs down to 2025, and every governor that comes in tries to stick with that plan. So there's a Lagos economic strategy plan that every governor follows through with. So if you look at that plan, you realize that you understand some of the reasons why the state currently does what it does. So there are no particular policy direction that it states out every year. So my first encouragement is to get that plan and study it, all right, to know where the critical investment areas are. Secondly, I wouldn't advise a long-term engagement, all right. I would want to advise sectors where the numbers are and where you can pull off something within the short and medium term, all right. Thirdly or fourthly, I would also want to encourage that if you can find a policy, we'll call it a policy champion, an individual internally who can champion your cause in the sense that you can get timely and up-to-date information on how the government, because it's still a very fluid system. With the rise of COVID-19, the NSAS movement, and the recession, all right, the Lagos state economy in 2021 will be seeking more to rebuild. All right, the economy will be seeking more to rebuild. So there'll be a lot of investment in SMEs. There's going to be a lot of investment in technical vocations, all right, in trainings, all right. There's going to be a lot of engagement in FMCGs too, all right. So I don't know the line of business and the initial ideas in the minds of Opeyemi, but I'm just trying to speak broadly and all that. In fact, they've released there's an LSETF fund to help SMEs whose stores were looted and who were greatly affected both from the pandemic and the NSAS protests and all the like. So we want to think of what are short-term engagements that the state government is putting out there, all right, to rebuild, the economy. And when the state government is rebuilding, they're thinking of majorly infrastructure, all right, or maybe softer infrastructure, all right, or SME development largely, and then job creation. So whatever initiative or ideas you have along those three processes, especially service-driven, all right, so you don't have to tie your engagement to a longer term, because 2021, 2022 is still going to be very volatile. So I wouldn't encourage business with state governments for a long term at this particular time. And after 2022 comes an election year. So going forward, it's still going to be relatively dicey, and a short to mid-term engagement where the numbers are and the rebuilding interest are is your win for now. And of course, having a stakeholder internally, having somebody internally that can help you with information and can help you champion your cause.
Wow, that's a very powerful roadmap you painted there. So we've come to that part. I hope you still have like 10 minutes for us.
Surely, I'm on standby for any question.
Okay, great. So there are two things we normally ask our guests. And so at this point, I think we need to ask you so that we don't use up all of your afternoon. So one is, tell us your exciting journey. Tell us your unique journey. This is one of a kind. Not so many people play in the space you have. In Nigeria, what you're doing is not so common. In fact, I think there are only two people I know who do a bit of what you, or who play similar roles. Bismarck, Rewan, and Andrew Nevin. They are kind of the only people I can say, okay, they are in this very space you are in. So can you tell us how your journey started? It will be very inspiring for a lot of people.
Okay. So can you please take me back to the my profile slide, so it's easier for me to talk you through. So primarily, I did economics from school. I came out, tried to close my gaps, knowledge gaps, skills gaps, and all the likes. Michael was very helpful at the time too. So of course, I sought to close the gap because as an economist, I've followed the trend for a long time. I worked with Unilever. as a consumer market analyst, and I interacted a lot with market dynamics, with consumers, with retailers, with producers, with please can we go to slide 5, please? Slide 4. Slide 4. Sorry. Yeah. So I did a lot of engagement with all of these different organizations. Then in working with them, one of the things I realized was that there was a huge gap between the macroeconomics and the microeconomics. And the micro is basically talking about consumers, firms, households, and businesses, all right? But the macro talks about the big things, exchange rate and all of that. So there's a lot of emphasis on the exchange rate and quote unquote investment/financial market, that it loses a widespread touch on the consumers, who at the end of the day, because of the law of large numbers, influence how those dynamics shape. So it's because Nigeria is an intensely import-driven economy. That's one reason why you have a lot of pressure on FX, all right? And because the macroeconomics has not properly expanded or opened the access to market in terms of exports. That's one of the reasons why we can't make so much on non-oil. So I sat down and I looked and I identified this gap. It was a very difficult move. I was working with ExxonMobil at the time as a tax analyst. So I resigned from Exxon to start Streetnomics. And I started in 2016. And since then, I have not looked back. And I've been doing this full time. So we've been doing this Outlook every year, January of every year, trying to close the gap between the macro and the micro, and then in between pitching, making a case on how businesses can begin to engage the market creatively, and thankfully we've been able to navigate here and there. It's been a very difficult journey. It's very difficult because it has its own learning curves. Like Michael said, very rare also. Okay, a lot of people in this space are either very senior, very, very senior, and they probably have built one or two organizations who do one out of many of these things. All right. So I thought to do that and spread my focus a bit. So, and again, getting adequate, and I noticed that the core is R&D, research and development. All right. Through research, you can build your data, and through intelligence, you can use that data to make critical decisions and then improve your results in the marketplace, which we call development. So research and development. So I had the opportunity to travel to Nairobi to do an advanced research design course. And then I did an impact evaluation course. I did a Bloomberg certification course. I started CFA at some point, although I'll go back to it next year. I did a course with Orange Academy in Lagos. I did a course with Wharton School on customer analytics. And just like that, I started applying. Can we go to the next slide, please? Just like that, I started applying. And then I was able to, it took a lot of self-evaluation to close the gap between economics and practice. All right, practice when it comes to market, consumers, stakeholders, policy. So as I moved on, I realized that there are different expressions of this need for use of data to improve the quality of market engagement and profitability or cash flow position for different stakeholders. So I had the opportunity to work with the Anambra State government on the SDGs, Sustainable Development Goals. All right, we had the opportunity of working with the Bayelsa State government, in providing an economic strategy. It was in the manifesto document for one of the governors who ran in the last election. Okay, we worked in Nigerian Economy Summit Group several times, writing reports. Then also the World Economic Forum Global Competitiveness Report. Because they administered these surveys through local champions. What I mean by local champions, it means representatives in different countries that can reach executives. So we for like 3-4 years consecutively, we were part of those who helped them to execute these surveys on the globe. So every information you see on the Global Competitiveness Report, the last, before 2018, 2017 to 2016, 2018 to, we're also part of those who pulled the interviews and all that. With Ford Foundation, I did a policy research for 2-3 years with Ford Foundation, trying to understand the demand side and supply side of the education to employment markets. All right, certificates versus competence. What would employers hire for? All right, so I surveyed supply side, talking about the school universities, the academic learning institutes, the lecturers, the parents, all right, trying to understand certificates of competence. What do you prepare these children for, all right, or these young people for? Then I surveyed the demand side, okay? I interviewed about 500 employers of labor in Nigeria. The goal was just to understand and to close to identify the supply-demand gaps. You know, for Access Bank, Diamond Bank, we worked on the post-merger research, all right? Access Bank wanted to understand what are the major fears of consumers. And that's why I was saying that for these banks and these corporates and these businesses, especially those listed on the stock exchange, when you take out the consumers and the large numbers at the base, they are no longer in business. So they understand these things. So if you're buying a share and a stock with these companies, you also want to work backwards and proactively try to understand how they engage their markets, because that will determine the length of stake and then what strategy they are using. That will determine the continuity of the investments and many other things else. You can even personally forecast their profitability positions, revenue positions by yourself. So we did this research and we did it across 7 different stakeholders: Access Bank staff, Access Bank customers, Diamond Bank staff, Diamond Bank customers, financial experts, participants of the Diamond Bet Challenge. You know, so our work is very rigorous in research, very intense. We've run Outlook sessions with First Bank, Outlook sessions with Fidelity Bank SMEs. We've run Outlook sessions just recently. Last week, we did one with First Bank brokers. Okay, we've run Outlook sessions with Leadway Assurance and their affiliates. You know, I was a technical evaluation analyst on the Empower VATE program. You know, so we've done a lot of intense work. We've worked in different industries, worked in Michelin. The goal with Michelin was to analyze the tire markets, and we did that across 8 states in Nigeria. You know, I remember, and we worked in very difficult spaces trying to pull out the numbers. And because of this level of intense work, we had the opportunity of being featured for the first time in 2018 on ChannelsTV, you know, talking about the government policies then, you know, around SME development and all that. And since 2018 till 2020, we've had 56 appearances on the media, you know, talking about one government policy or the other, from budget to jobs, from jobs to finance bill, from finance bill to policy, from policy to SME development, to virtually every report the Nigerian Bureau of Statistics releases every month. All right, we have the opportunity of talking about these things, and we've done them. Please come on to the next slide, sir. We've done them in ChannelsTV. I've been to Robin Minds to talk about these key issues, especially tying the economy to the millennials and to young people and all of these things. PlusTV has also, we had the opportunity to feature there about 19 times, featured in Lagos television about 18 times, had an appearance on BBC when the Senate made mention of when the federal government shut its borders as a result of smuggling. So the first border shut in 2019, I think. Yeah, you know, we had the opportunity of being in BBC to talk about these things and why a border shut. And my position was this: shutting borders will only close your economy to external markets. No economy is 100%, how will I put it, resistant of smugglers and all that. The most important thing is to work on build a structural fundamentals, so you are exporting more than you have to do with this. And then if you need to close borders, probably you may need to think of those things in phases, all right, not a one-stop policy position. And that's why during the course of the presentation, I talked about incoherent and inconsistent policies. And one of our positions so far has been that we think the central bank is stretched. The central bank is trying to do a whole lot more than is expected to do or designated for or built or designed for around regulations and financial markets. So the central bank is delving into core fiscal areas where the federal government should be responsible for. And because of the long-standing fiscal indiscipline, all right, there is a gap there the central bank is trying to fill. And as such, the central bank is overstretched and having to deal with many windows of FX and all of these things. As a result of then again, fiscal excesses, high cost of governance, fiscal indiscipline, you know, and all of these things. So our analyses are deep and very dynamic, and we try to situate them. We take it from top down so that we can help businesses, investors, and all of that have a more bottom top lens view, all right, on how best to engage. So so that is basically how we've navigated. It's been a very difficult and very tough experience, but we've tried to push, tried to work hard, and thankfully we've had a lot of bricks around policy, around business research, around financial investment research, around core economic research, and all of these things. So thank you again for having me, and I'm still open to questions if there are any.
Okay, so I'm just checking the chat box. I think some are piling up, but I will have to finish the two primary ones. So a follow-up of the one you just answered. So for those of us in the consulting space, training easy. You just give them a price for, how many days. There are a lot of models to how you cost the training per person, per days. And then some consulting job too is a bit easy. If I'm in HR, it could be like maybe per every staff or per every engagement. But for this kind of strategy and R&D, for you, you've worked in Unilever, you've worked in ExxonMobil, and then you have to leave that space. You have to leave that, I call it a comfort zone, because in the consulting space, you have to do your pricing too. How has it been easy? Because from the little experience I have with most companies, they still struggle with paying for those things that they look a bit like intangible, sort of things that a bit more like on the strategy side, So how have you been able to navigate that space of, doing this full time, not regretting leaving your work, and then being able to get, them to pay you what is really what is the value that is really worth it? How have you been able to navigate that aspect in our Nigerian space?
Okay, so one of the things I over time, in course of doing everything, I arrived at as a learning for me was that the Nigerian economy is not well structured on the service sector, which is why I said something initially. The Nigerian economy is technically diversified already. The problem is not diversifying the Nigerian economy. The problem is how do we diversify the productivity and revenue base of the non-oil sector. If you look at the GDP spread very well, you realize that services takes about over 50% of the Nigerian economy. So we are a huge service-driven economy. And I was supposed to say this, but I didn't get the chance to say this. I probably didn't remember in the course of the presentation that the Nigerian GDP numbers are grossly underestimated. There is a lot going on. There is first an informal economy. Then even within the formal economy, there is a lot going on that we've not been able to properly account for. So the economy is actually moving at a faster pace than it's being captured, then compared to than it's being reported. So like I said, if you're an organization, an individual, or doing business, and you are planning based on what the NBS releases a quarter after that's reported GDP for your company strategy or anything, you are on the proactive side of strategy. So we need to, as business people, we need to move from that part to start thinking on the proactive. And one of the things I realized that since the service economy is not taken so seriously, is not properly structured, so it looks like an all man for himself scenario. So one of the things I think I was able to do is to also clearly define my path. And when I defined it, I tried to redefine other streams of income and other markets. So that graph I showed us about the Nigerian map and then cluster. It's just because this is a market profitability session. If it was more of a market strategy session, all right, the flip would have been it. Okay, look at your industry. Who are your target markets? Now, because markets are constantly redistributing, it also means that in your target market comes different target segments. So there are different target segments under a target market. So target market like the umbrella, then the segment is like every other part of the umbrella that holds it together in the center. So, and that part is a level of difficulty that many businesses, I'm still even trying to redefine mine too, because as things change, disposables and other things are changing. I'm redefining, I'm still trying to get the model right, but I'm just trying to freely share. Target market is easier to define than target segment. So there's a target market, then there's a target market segment. So every target market is broken down to 4 segments, and you can segment by income, you can segment by experience, you can segment by location, you can segment by purchasing power, you can segment by need. And if you look at, there was another slide again where I put the consumer landscape around 3 layers. There is a low, there is a rising, there's a thriving. Now, because things are changing, consumers are more price sensitive, and the economy is changing so fast. Somebody in rising today can be in thriving tomorrow. Somebody in thriving today can drop to rising tomorrow. Somebody on the middle class today, on the higher middle class or upper middle class, can be on the lower middle class today. So things are changing. The market is redistributing so fast. And I think it's one area that businesses have not been able to tame. So many businesses have not been able to define their target market, not to talk of defining their target market segment. So I think the work is in, first of all, understanding that the services industry is largely underestimated but extremely powerful in the Nigerian sector. Number two is to define the market segment, then the market target market, then the target market segments. Then drilling down each segment to understand their needs, the critical factors by whatsoever industry you're in and whatsoever metric you're using to drill your segments. All right. Then once those needs have been mapped, then the question now comes to the solution I'm offering. How can I use this same solution to offer different markets? We are still trying to get the model right. But thankfully, one thing I've noticed is R&D is big and complex. All right. So R&D in itself, I realize that I can do R&D for any sector. So if you look at the portfolio profile, you realize that I've worked with about 15 sectors: automobile, food, sports, bets, entertainment, church, all right, healthcare. I've done research in so many of these sectors. Now, so R&D for me was different sectors will need R&D. But now further down the line, and I realized that different stakeholders also need R&D for different reasons. So even in segmentations, there are different complexities. So when you segment and you get those complexities clear and right, then you begin to tailor your product into that different segment request. Because training is a very sensitive market. Once recession hits, companies take out training. All right. Now that consumer spending is getting more intense and consumers are getting more price sensitive, it's going to be very difficult for people to pay for trainings. In fact, there's now what they call training fatigue. People are getting so tired of trainings and doing training so much that they're not applying and they're not seeing results, and there's just a gap. Some persons know how to train well, some people don't know how to train well, some persons know the subject well, so there are many dynamics around this training industry. So upon breaking down the target market segment, you can retweak your solution segment based. So the same R&D I would do for a government or social enterprise, it will be called policy research or policy analysis. It's the same R&D I would do for business, I would call business research or business consulting or business advisory. It depends on the level of scope and scale. The same R&D I'll probably do for a church. And I also have an outlook for churches. I've been doing that for the past 2 years. So different markets who need data. For instance, on my end, I repackage the solution differently for the segments. That's another way we can think of it. Then lastly, I would also say that I think we also need to be flexible, all right, to keep a tab on how the segment interests are changing and how our value propositions need to change. Then also, it's good to do business that the world is looking forward to, all right, especially in technology. But we also need to understand our target market enough to know if it's the right time to introduce a solution, or if they can pay for it, or if they're interested. So many consumers are willing, but they are not able. Some are able, but they are not willing. So it's now to know the different dynamics.
Wow.
But it's a very difficult learning curve.
Thanks a lot. There's one question that is left, and then I need to also let you be aware that all your services, I'm sure there will be people here who they might need your services, or they might be part of decision makers in their company, and it would be good how they can reach you to know more about your services. So I want you to maybe help us do both in the same succession. So the last question someone asked, which I promised him that I will read out to you. So Oluwaseun Adeleye is asking that how can one give an assured statement? How can one give an assured statement or insight, especially when combining primary and external data? Did you get the question?
Okay, yeah. I'm trying to understand. Okay, how can one give an assured statement or insight, especially when combining primary data and external data? So that's the word assured statement I want to take in as a recommendation or something like that, or an analyst position, something like that. But then I'm trying to also understand what the difference is between primary and external data in this context, because it's either primary or secondary, So primary, if Oluwaseun can throw more light in what he means by external data, because primary data is actually being gotten externally, in quotes. You go out to get it. All right, it's data you get from scratch. Secondary data is data that's probably been collated somewhere in a particular format, and you probably have to clean up that format or use in that particular format. So it looks like primary and external data are one here, from my own understanding. If there is another perspective to external data, I'll be happy to hear so that I can answer the question properly based on my understanding.
All right, so I think we can go to the last one then, which is thank you very much for coming, and how can people engage you? So there are people here who maybe they are owners of their companies, they are part of management, or they are even part of the team that needs to give recommendations for their companies on who to engage for next year. So we want you to, at least we cannot pay you honorarium. We don't have, so for this that you've done, at least let us make it possible that you can make people be aware of your services and how they can engage you. If you need me to even share my web screen and go to any website that you want me to navigate to, anything you
want. Okay. Okay, so we can, so if you go to the third slide, please. Okay. It's everything we do there is captured there, but we have a website. So you can go to the website and also check more on it. No, I think yes, this one. So we do socioeconomic research, and across this is just because I want to explain. All right, but the website is www.streetnomics.ok. So, but these are breakdown details of what we do. We do socioeconomic research. Like I mentioned, we've done policy research for a lot of government and DFIs and social enterprises. We do economic and business outlook sessions. So this session we are having now is an outlook, but it's an outlook snapshot because we are fleshing out ideas for our main outlook coming in on February 6th. All right. Then we can do, okay, my slides is out now. Let me just pick it out here. We do, no problem. I just want to be sure that I am.
Sorry, I'll put it back on.
Okay, so so we do economic and business outlook sessions. So we've done these economic and business outlook sessions for First Bank SME Connect, for Fidelity Bank SME Connect. We've done sessions with InterSwitch. We've done sessions with InterSwitch during the Corona, the lockdown. So the uncertainty led to a lot of asking of questions, and we do unit-focused outlook, especially when it comes to the market. So, for example, the one we did in Outlook was looking at how the one we did with InterSwitch was looking at how the pandemic era would influence talent management and remote work. That was an intense 2-hour outlook session. So it was an outlook for talent management in the midst of a pandemic. So it's good to have HR executives talk about things, or HR practitioner, but some of the times you want to have an economist who is telling you from a core, from a more system-wide perspective, and then you infuse with other in-house technical ideas. Then we do development communications, brand building, management, and all that. Then, but the core is market intelligence and development. So market research, data analysis, outsourcing, and a lot of these interesting things. So the website is www.streetnomics, and then you can reach us on 081. Maybe I should just type it there.
Okay.
081 0070791. So you can reach me here, or you can reach me on or I'm Gospel Obele on LinkedIn. Okay, so that's basically it.
So thank you very much once again. We're very
thank you so much, Michael, for the time.
And we all hope that next year is going to be very great. And we all hope that that recovery that will sit on the fence, it will not crack. it will get better. It will be that way. But thank you very much. And
fingers are crossed. Thank you so much, everyone, for having me. Really appreciate it. Thank you, sir. Thank you, Michael.
Bye.
Have a great afternoon. Thank you, everyone. Thank you so much.